What's cracking, Ma? So margin versus cash. When do you know that it's okay to start trading margin? So this is the type of question that comes up for stock traders, right? Because obviously all futures trading takes place in a margin account, right? So I'll take that aside and address the stock traders out there. So let's say you got 50K and you want to trade, at that point, I think over 25, you're afforded day trading buying power, which can bring you up to whatever intraday 4 times your capital. So if you had 50K, you could trade up to 200 intraday. You could take home Reg T. Reg T is where you commit a minimum of 50% of the marginable security, and I think you can take home 100,000 of market value with 50,000 of equity, cash being equity, right? You put that money to work, 50K, you can buy up to $100,000 worth of marginable securities. And so, when do you know to go from one to the other? And so my thought process is a couple of things. One is it makes sense to use margin when, you're a long only trader and you're in raging bull markets, right? I don't feel like that's where we are right now. Obviously, there's a bull market somewhere, but overall tenor and tone of the marketplace isn't necessarily bullish with everything that's going on. Obviously, you can take and highlight whatever it is that you want in and around the market and the economy and highlight that and use that as a standalone, right, or a segment. But I don't know that you can extrapolate it for the entire overall market. There's too many other things going on. That being said, I think what can you look at that's black and white? That's like I said with Ken Revisa the other day, control the controllables. You can see the results of your own behavior. You can see your P&L. You can see the number of trades. You can divide long versus short. You could say, here's where I added to my winners or not, and what those numbers look like. And, guys especially have this issue about getting bigger. When do you scale up? And I feel like that's not something that you should be worried about. The thing that you should be thinking about or pondering, if you will, or putting critical thought into is your process. Your process is probably scalable, but can you repeat it and act consistently, right? That to me is the mark of a pro. Further, if you're not making money with cash, say you have 10K of your 25 or your 50K that you're working with, and you can't make small bits of return, call it 10%. It doesn't matter to me what the numbers are. But however you define profitability, can you be profitable with cash? And I'm talking like for the year, not 3 months. Who cares about 3 months? I know I'd rather win for 3 months than lose, but 3 months is not really a lot of time in terms of statistical significance. Don't get me wrong. It feels good to win. I get it. But in order to make a big financial decision based on 3 months, where if you were in my court and I was the judge and I was listening to you on the witness stand saying that because you had 9 months of losing and 3 months of winning, that all of a sudden you're onto something, I'd be skeptical, excuse me. I'd wonder, like, is the broken clock right twice a day kind of a deal? Like, are you just in the right place at the right time? Like making money with a bad strategy because the market is acting a certain way, right? Whereas you had more months of losing. Conversely, you could say, well, it took me 9 months to figure it out. I'm like, great, it took me 4.5 years. So if you did it in 9 months, awesome. You're far ahead of the game as far as I'm concerned. But 3 months isn't really enough time to say for sure. Now, too, we have to take into consideration the quality of the money. You should really only trade money that you can afford to lose, and understand that from having spoken with someone who can give you very objective, who knows you personally and can give you very objective advice. That's not me, because I don't know you. In the same breath, while I would be enthused for sure for a 3-month winning streak, I don't necessarily know that having a 3-month winning streak infers that I have a winning strategy. Sorry to be the reality call. In other words, you need to see much more consistency for a longer period of time before you'd want to use leverage. Because in my mind's eye, why? Because leverage enhances gain, it also enhances losses. So why would I want to enhance my loss potential if I haven't really figured something out just because I want the emotional win of trying to trade bigger because it feels better for my self-esteem? I would say no to that. Stay small, stay safer. It's probably hard enough to get the money in the grub stake in the first place and go with it, stick with it, and figure that out over a longer period of time. So that would be like the big indicator to me is like, can you make money consistently with just cash or a fraction of the cash that you have, right? Then getting to be fully invested. And I'm not the only one who said it, that you could make a lot of money and not even be fully invested and never have to use margin. So I guess the question would be is like, why would you need again, we're talking stocks, right? And we're talking probably about buying things long, right? Because the shorting mechanism is very different in stocks than it is for futures, right? There has to be a borrow and the blah, blah, blah. Don't want to get into that here. I presume you know that. Futures, again, just to reiterate, all futures trading takes place in a futures margin account. So you can't really get around that. You can trade notional value in futures if you multiply the price, by the standardized contract, right? So if you had $250,000, you could buy one gold contract and effectively take the leverage out, because if you multiplied 100 troy ounces by whatever it is, 2,000 ounces, and came up with that notional, the product of that mathematical operation would be what we call the notional value. And if you had, say, 500,000 in your account and you were trading one gold contract, since you have enough to buy all of the notional value of the gold, to me, you'd kind of be taking the leverage out of that equation. That's the other way to look at it. And some people do that. I think in terms of adding leverage, what's the point, right? Right? Is it because you want to trade bigger? That to me is that's an emotional thing, right? It's not a financial one. I want to trade bigger. I want to trade fives and tens. Okay, right? So I get it. 10 of the mini and the MQs or whatever they are at 10 points could be equal to the one Big Daddy. If you traded 5 of them, you'd kind of be cutting the big contract in half, which you can't really do, but you can get a surrogate, right, if you did that. But again, that's futures. If you're looking at stocks, what's the point? What's the payoff? And again, think about the two payoffs. There's an emotional and psychological payoff, and then there's the financial payoff. If you haven't demonstrated in all objectivity that you can make money with cash over like 6 to 12 months, i.e., over some changing environments, right? I wouldn't invite leverage to the party just yet, right? Because that's it. The sword cuts both ways there. And while making money can be exciting and enhancing your returns can be good, trust me when I tell you, when you're in a position that's leveraged, that's losing money, that gets ugly quickly. And it's interesting, just as an aside, I've seen more equity guys try to go to futures and get killed than vice versa. Why? Well, because future guys are commodity traders understand that because of the leverage, if you smell smoke, you have to assume it's a 5-alarm blaze. So, and the natural order of things is to trade with protective stops. There's no like, I'm going to buy 100 shares of Citigroup and not worry about it because it's making 52-week highs. And it's a blue chip stock. It pays a dividend, flight to quality. I get it. I get it. There's all those reasons why you can just kind of wing it. But with futures, that is not afforded to you, right? You can't take a big hit on a futures position and then be like, oh yeah, let's try to figure out why the house is burning down while you're still in it, right? You have to protect your cash. That's what stops are for. And get out. You can think about the reasons why afterwards. So those are the types of things that I would consider. Certainly if you were to get an allocation, I'd be looking at those types of things in your performance and asking you questions about it to see not just what you think, but how do you feel? Because your feelings and your emotions are what really drive everything. Doesn't matter whether you think you have fully systematized things or whether you're a discretionary chart reader. Everybody's running an emotional system. And that's inescapable in my mind's eye. And I would debate anybody on that. So anyway, those are my thoughts. The job, don't forget, is not to go hell bent for election to make money. Your job as a speculator is to play superior defense. And what you don't lose, you don't have to earn back. So be super, super conscientious of protecting your capital. Right? To me, it doesn't matter whether you're trading crude futures or you're trading penny stocks or whatever it is that you might be doing, scripts over in India, F&O segment in India, doesn't matter to me. European stuff, currency pairs, I don't care about that. The job is to protect your capital. So sometimes you have to save yourself from yourself. And that might mean, putting the whole, I want to trade this year on margin, or I want to get myself to 25K so I can do day trading buying power. That's even worse, right? So it might seem exciting, but again, until you have the track record and the consistency and the emotional control that you're not going to freak out, trading 4 times the capital is absolutely out of the question. No chance. There's just too much risk. It doesn't make sense. Again, if you're trained, we're having a different conversation. I'm speaking to the autodidacts like myself who are self-taught for the most part. You're picking things up here and there from people, but without any real training, you're putting yourself in a tough spot. And what you don't want to do is take a hit on your cash and set yourself back because you did something stupid, especially if you were ignorant, or if you found yourself being financially compromised in your account because you were going after an emotional need. This happens obviously all the time, right? So I would back away from that and just take my time and say, I enjoy the ride. I've got the cash for what I'm doing now. You're getting paid, on average. Run your system on cash. And then, we can talk about position sizing, but then also how do you think about diversification, right? Which is risk reduction versus risk management. And how, when you try to optimize your portfolio, taking into account, again, we're talking about equities here, how many names do you add to your portfolio in order to benefit from the diversification properties that you can get to reduce and or potentially eliminate as much of the unsystematic risk as possible, and then how to deal with systematic risk. That's a longer conversation, probably needs some slides, in this and that. But I know plenty of people who are not even using margin, who have tens of millions of dollars, and are making, over 100% a year just using their cash. So that's what I would try to focus on before I would worry about borrowing money to enhance my returns. Said a lot about it. Probably could have said it in half the time, but I like you guys. I like talking to you. If I didn't have you to talk to, who'd I talk to? My red Dalmatian? Come on. There's no such thing as red Dalmatians. Anyway, love you all. Thanks for being here, and I'll see you tomorrow.